So I'm here to also welcome you. There's a sort of a mixed group. Obviously there's a lot of clients and friends of Wilf and Kathy here, and but there wasn't enough of you, so then we added some other people. so there's a group from Ilderton and St. Mary's, etc. that's here as well, and Tillsonburg. I don't want to forget Tillsonburg. So I'm sure by the end of the night everyone will be friends, and I thought I would take this opportunity to introduce the rest of the team. I mean, I think obviously everybody knows Wilf and Kathy, and for the people from outside of Waterloo, that was Wilf, and Kathy you'll know by the end of the night, and she'll know you very well as well. Myself, Paul, the M in the JMRD, Reg Jackson, the J, whereas Jaden is the R. Who we're missing tonight is Zach Davidson, who is in full Blue Jays garb in front of TV somewhere, and he's our partner in Toronto. And then for the Waterloo folks, you definitely know Catherine back here, and Steve Lochner is also in our Waterloo office. Behind there, the tall guy, is Matt Albers. Kelly. And one of our new hires in the London office, and I kicked Jaden out of my office. So Jaden and I lived together in an office for I think about 5 years until we broke up recently. And Matt moved in.
Got a better upgrade.
And Faith Hatt is the shorter one beside Matt, who's also in our London office. Exactly, it's a beard thing too, yeah. So with that, I also want to introduce another member of our team, and she's more of an extended member of the family. I have her bio here, but half the people know her. We've been introduced to Marie as somebody who's done your financial plan, or who we've talked to you about doing a financial plan with. So we thought we'd bring her back because everybody really likes her, and we want to make sure that you know, if you've done a plan with her before, you get a chance to talk to her about that. And if you haven't done a plan, she's going to talk a little bit about what she does for our team.
So there's been some interesting things here, and before we start, I'm going to come clean on something that I did as recently as about 6:30 this morning. I had some meetings early, so I've told a couple of people this already. I had some meetings this morning, and yesterday the market was up huge. You know, we were up like 300 points or something on the Dow, and there was this great big rally, and I had early morning meetings, and then we had some meetings here today. And yes, I did go down to the office and printed off brand new statements to reflect the move in the market yesterday. And I had a meeting, and the people are in this room. It was interesting, and the point that I'm making is this is what this market is like right now. The rates of return on their statements, you know, as of Wednesday's close, was up 0.5% year to date. And over the same period of time, the Toronto Stock Exchange was down about 5. Dow Jones was down about 2. The rate of return as of Thursday's close, 1 day later, was almost 2% higher. Right? And again, we didn't have an opportunity to include what happened today, but again, we could certainly factor in another lift in the market. So we're looking at these massive swings in the markets, huge volatility. And again, it's great today, you know, Game 6 of the Jays, that the market is also going, you know, higher. The statements look, I'm not going to say that the statements look great, but they look better than they did a week ago. They look better than they looked a month ago. But these are the types of swings that we're seeing in the market. Lots of volatility, and I guess expect to see that continue going forward. But again, that was just such a big move in the last couple days. And I asked a question. I wanted to bring this stat up. I had a whole bunch of stats, but I'm going to reduce 5 of them down to 1, because this is the one that I found the most interesting today. And the people that I was chatting with that don't answer this, but a question that if you wanted to lend the German government money for 6 years, so similar to buying, you know, a 5-year Canadian bond. So think about buying a 6-year German bond. Any guess on what type of interest payment you would receive? Oh, I heard the answer already.
Yeah.
It's negative. 6-year German bonds have a negative yield. Wrap your head around that one. negative, right? So 1-year GICs in Canada, right? Bank rate in Canada right now, 0.5%. So 1-year GICs, obviously a function of the current interest rate environment in Canada. 1-year GICs right now in Canada, paying somewhere a little bit north of 1%. 5-year GICs in Canada now paying a little bit over 2%. 6 years in Germany, you pay them a privilege of actually giving you their money. So give that a little bit of thought, which is interesting. So I'm going to move pretty quickly now. Total returns. This is a chart that we like to look at, and there's a real point here. And this is as of the end of September. And really, let's just look over here, because the whole point there that we want to be talking about is portfolio construction, portfolio development, talking about asset allocation, where we should be putting our money. And we clearly don't want to be putting all of our money in one spot. We don't want to be taking great big sector bets, great big geographic bets, great big currency bets, great big, asset class bets. And again, just starting here at the top, it's kind of, well, what have bonds done, year to date? And again, cash is basically paying nothing. And you can see the various rates of return with some of the various bond indices that we have. This gets a little bit interesting, what has been happening in the equity market. And again, September here, year to date, the world equity market, down 6.6%. Like, what has happened in October is, it's mind-boggling, right? We're up 4, 5, 6% this month alone. So these swings that we can see, don't get too euphoric when the market is going through the roof, and don't get too depressed. That was the whole point of showing that video. Not only along, we are more technologically savvy than we were a year ago. But again, in Canada, 7%. But again, even in Canada, right, the main index was down 7, but the small cap was down 14. S&P 500 down 5. We had the Russell down 8. EFI down 5. MSCI emerging markets down 15. Some big differences here. And then just looking at the various commodities, one of the struggles that we're having in Canada is obviously what's happening with the price of oil. June, July of last year, the price of oil was around $100. Today it's roughly $45, $50, depending on what day of the week you're going to be looking at it. But again, year to date, we're already down 16%. You can see what's happening with gold. You can see what's happening with copper. In a portfolio, it's been nice to have some US dollars, right? So you want to diversify not only by asset class and by geography, but again, currency certainly makes a big difference, because again, the US dollar has continued to appreciate against the Canadian dollar, and you can see some of the other currencies. So the whole point of looking at this chart is, there's some good numbers over here, there's some bad numbers, and hopefully, with some proper diversification, and hopefully some proper, security selection, we can come up with some positive gains. So we'll go to the next slide. We have on the JMRD team 4 main baskets, and I'm going to go through them very, very fast, and there's really a point here. I'm not trying to plug any one of them. The point that I would make is, if we get to January 1st of 2016, it's like 4 stocks. Okay, you have these 4 choices. Here's what I know. One of them will be the top performer, one of them will be the second best performer, one will be the third and the fourth, etc. Do you want to take those types of bets, or do you want to have a little bit a mix of the 4 of them? So we thought that this would be interesting. This is as of October the 19th. This is the DIG basket, and the DIG basket stands for Diversified Income and Growth. This is those stocks that we like to put together, clients that are looking for conservative, blue chip, dividend paying stocks. The problem is, top quality, blue chip, dividend paying stocks have lagged, right? Year to date, I've been out of the office today, but year to date, TransCanada, I would say TransCanada is a blue chip dividend paying stock. It's down 20% year to date. The Canadian banks as a group are negative year to date. We know what's happening with energy, so obviously the energy stocks are negative year to date. And some of them, in a pretty significant way. this was just the other day. You know, we were down about 1.5% year to date. We did creep into positive territory today.
Briefly, yeah, but just under right now.
So you know, in 2 days, you know, we've clawed our way back. But again, who knows what's going to happen next week? So you know, we still like the banks, we still like the Teluses and the BCEs of the world, the blue chip dividend paying names, but they haven't done a whole heck of a lot this year. We'd say that maybe they're down, but they're certainly not out. You know, and it would certainly be an appropriate, you know, part of anybody's portfolio. But again, hasn't done much of anything year to date. These are the actual holdings. So again, when you know, we'll recognize most of these names: Agrium, Brookfield Asset Management, Dollarama, Kiera, Magna, TELUS, TD Bank, etc. One interesting thing, just this last one at the bottom, WSP Global. So WSP Global, this was formerly called Genevard. I think we all know what happened in the recent election. We have a Liberal landslide, and one of the things that Justin Trudeau has been talking about is a huge government spend on infrastructure. So again, we immediately saw a pretty big move in not only the publicly traded construction companies, but also the publicly traded engineering firms. So WSP is an engineering firm. So we really like that theme. So again, one of those names that might be interesting going forward. So to complement the DIG basket is our second basket called the all cap basket. And again, you see here right away the difference between the DIG basket, you know, which is, you know, basically flat year to date. You know, the all cap basket is now, it's actually up over 10% year to date. So again, the difference between these two baskets, one is very, very income oriented. You know, we want cash flows. That's our number one focus in that basket. Where we're looking at in the all cap basket is more on the growth side. There's certain themes that we like to look at. The companies that we would look at here don't necessarily need to pay a dividend. And one of the themes that we really like that has been working out here is recognizing and investing in companies that realize a significant portion of their revenue in US dollars, right? So that has been a big win as they have to realize that in Canadian dollars when they report earnings. Might be a little bit of you know, not as many recognizable names, but we have, you know, Couche-Tard, Boyd Group is in that US theme and the automotive theme, Constellation Software, CGI, obviously another technology company, Magna on the auto parts company, Stella Jones, you know, interesting company there that makes railroad ties and telephone poles, but still also some recognizable names with Sun Life. And Restaurant Brands is the, I guess the new name for Tim Hortons. So again, a pretty interesting company. So we wouldn't want to just own the DIG basket, and we wouldn't want to just own the all cap basket, but having a little bit of both, we think makes a lot of sense. Third basket we have is the ETF basket. ETF stands for Exchange Traded Fund. This is kind of the basket that we're looking at. Okay, we want to get some, as you can see from the pie chart here, you know, we want some U.S. exposure, we want some international exposure. You know, we want to have, you know, a lot of investments, you know, scattered throughout the world, not only, you know, by geography, but also by asset class. And again, you know, we've been cruising along quite well, but again, as of the other day, you know, we were down to, did we get break even in the last couple of days?
Almost.
So,
0.3
again,
to the down.
you know, as you saw from that first slide, you know, the world equity index was down 6.6% at the end of September. You know, so if you're in an ETF basket and you own the S&P 500, well, that's what the S&P 500 is at. And then it comes down to whether you own it in US dollars or Canadian dollars. So again, we've had a big bounce back here in October. And again, we want to have exposure to a number of different areas. If you look through those various ETFs we have, there's going to be different investment styles, there's going to be different geographic areas, and there's going to be you know, different sector bets, you know, whether it's technology and healthcare and a couple different areas. So again, we can almost think about these various baskets as individual stocks. right? We don't want to just own one of them. We want a little combination, bring them all together. Keep looking at the clock here. We're gonna make this, guys. This is the U.S. basket, and these returns are in U.S. dollars. So you also get the currency lift. So we were at 15% last year, just the pure investment return. But when you factor in the U.S. dollar appreciation against the Canadian dollar, it was a lot better. So again, I think I was looking at Jaden sent the closes today. I think the Canadian dollar was around 75 and a half cents, something like that today. If the U.S. raises interest rates and we lower interest rates, obviously we're going to have, we might test 73, 72, who knows. But again, I think that, the big U.S. dollar move has probably happened. Again, unless we, see a $5 pullback in oil. And we cut interest rates. But again, we're looking at, up about 2.3%, and we had a nice little move today. This would be, again, a complement. Think about this as the US dollar dig basket. The companies don't necessarily need to pay a dividend, but we've really been focusing on coming up with US dollar solutions, not only just to have exposure, but also the US dollar as an investment on its own has turned out to be a pretty good strategy over the last couple of years. Pretty recognizable names, starting at the bottom, Visa, Starbucks, Nike, Home Depot, Apple. Apple had a huge day today. Facebook, this is interesting, that was just from the other day. We bought Facebook in this basket at $75. 2 days ago it was at 97. I think it closed at 102 today.
Mm-hmm.
So Facebook for the first time ever closed above $100. So again, it's interesting. We want to have exposure to different areas. Those are 4 different baskets, or think about them as 4 different stocks. And in a portfolio, JMRD would certainly recommend having exposure to a whole bunch of different areas. Because again, if we were sitting here on January 1st and we said, which basket do you think is going to perform better? Or here's 4 stocks, which one do you think is going to perform better? Right? It was interesting. Last night, I'll just use 2 examples. Pandora reported earnings. So Pandora is like an online music streaming company. And we had Google reported earnings. And I think, that'd be a pretty good bet. Which one do you think is going to perform? Nobody knows. Pandora was down 35%, and Google was up 10. But again, I wouldn't say that was obvious. It's obvious now because we know the answer. Diversify, diversify, diversify. So this comes back to when we're working with Marie, who's then working with you guys, coming up with a financial plan, coming up with risk tolerance and time horizon and all those other things. It really comes back to asset allocation. All of these different pieces that we've been talking about. And again, that's the type of stuff that we want to work with. Somebody coming in and saying, hey, I have X number of dollars and I want to invest it. Sure, we can invest that in 5 seconds. But again, we need to take the time. You need to take the time with us, to make sure that we're putting together something that's appropriate and that's hopefully going to meet and exceed your goals and expectations. So one more slide here, Jaden. This is an interesting, I recently did another presentation and I really like this slide and I wanted to include it. And if you look here at the top here, there's been study after study after study that basically asset allocation, the study these guys did, over 90% of the variability of returns comes back to asset allocation. It's not, hey, did we pick the right stock at the right time? It doesn't work that way. Sure, we could hit the odd home run, but again, over the long period of time, excess returns, the variability for returns really comes down to asset allocation. I think that is very, very important. I also like to include these. We don't really have to look at them a lot, but when we look at these 2 pies, and again, it's the Yale Endowment Fund and Tiger 21 Target Asset Allocation. I like to include those because they're different. There's a whole bunch of different colors, meaning there's a whole bunch of different things. Multi-asset classes. lots of different pieces, and I think that is one of the benefits that we can certainly bring when we're putting together those types of portfolios. So the wrap up number one, we're going to be on time and maybe even early, but past winners are not often tomorrow's winners, right? So it's not, we don't want to turn around and, I know I'm going to get calls on Monday and someone's going to say, should I buy Amazon? And you go, oh, you watch CNBC on Friday. It doesn't work that, that's already happened. Sure, we might want to own Amazon. Another interesting stat, okay, so I lied. I said I was going to, so number two is it was interesting this year, on a year-to-date basis, Walmart is now down 30%. Year-to-date, Walmart stock is down 30%. Amazon stock, year-to-date, is up 90. Somewhere, let's use that, it might be 80, but it's up 80 or 90%. Amazon's market cap, or what its net worth is on the stock market, now far exceeds that of Walmart. So again, the world is changing, trends are changing, and not only is Amazon larger than Walmart now, Walmart dwarfs them. It has been a huge, huge move, in the size of those two companies. So again, things change. So again, past winners, not often tomorrow's winners, and that's what we're looking at. Asset allocation, obviously, is key. Have a plan and review it regularly. That's why we love having Marie out. You can look at a portfolio, you can look at the returns, but sometimes it's, what are we can, you look at it and say, okay, there's my rate of return, is it good or not? Well, we can obviously benchmark it against what's happening elsewhere, or we can benchmark it in what I think is more important, to the plan. Are we meeting the plan, exceeding the plan, kind of getting behind the plan? And those are the types of things that we want to be reviewing on a regular basis. Can't say this one enough. Diversify to reduce the risk. Have exposure to lots of different areas, specifically by asset class. And the last thing, you're going to hear us talking about this quite a bit in the future, is putting together model portfolios. So we kind of have model portfolios, but what we want to do is use the various pieces that we have, the various baskets, the other solutions that we have, so that when clients are coming in, all things being equal, if two individuals, look the same, they should really have the same portfolio. So we're going to be, Jaden is the expert here, and he would love to get peppered with questions tonight on models. We're going to have kind of putting together a lot of these different pieces and some different solutions. So we're excited about that, and we'll be talking about it, in the weeks and months to come. But that gives you just a little bit of heads up if you see it in the Market Observer or anything. So with that, I'm not even going to take any questions. And I'll pass it on to Jaden, and we'll keep on schedule, but I'm here all night.
We're almost finished. Thanks for being patient. We've got a couple of good holiday reads for those two lucky people that can answer the following questions. And Reg maybe alluded to, he didn't give the answers out during the presentation, but he maybe hinted at what is, or some of the information in there may be a hint to what the answer might be. So Reg talked about the German 6-year bond yield, which is negative. Back to Canada, if you were to invest in a 10-year bond in Canada today, what would your average annual yield be for those 10 years?
So if they're lending money to the government of Canada for 10 years,
right, what would they give you per year? Don't be shy. 1 point what?
1.5.
Anybody else?
1.25.
Anybody else?
I think they want to know what the prize is. Is that?
I think we've got the answer. I just checked my note. 1.5 is pretty close. Who said 1.5?
Hey!
We'll give Tom first thing. It was 1.48 is the actual answer.
So what's interesting, right, is a 5-year GIC pays more and has no risk. That 5-year bond has a ton of risk at 1.5%.
So I've got an Elon Musk book, the CEO of Tesla, for the last prize. So I guess the last couple of years, energy prices, or the price of oil, has been in the news quite a bit. I think the Canadian oil stock index was down maybe 20% last year. What is the return of the Canadian energy stock index year to date?
Minus 16.
Jaden, is the Tesla included?
Does not.
He's right.
I'm gonna give it to Tom. It's minus 17, but
Oh, is it?
yeah, that's fine. Congratulations.
Hang on.
Anyways. Thanks again for coming.
I noticed they're both Jaden's buddies though. I'm just saying.
I like Tom. So we're around all night. Again, if you have questions, you might as well file out now, and then if there's questions later, you can take us aside later and ask away. Except about models. I'm not quite ready yet.
Thanks everybody.
Enjoy dinner. Have a moment.